So let's pick up where we left off, and then I'll talk to you towards the end of class about this stuff for next week. All right. So let's continue down the path of where we're going. Let's look at administrative powers and look at those powers that are going to be potentially problematic. So you can open up to code section 675, right? It's code section 675. We're just marching along. The grantor shall be treated as the owner of any portion, notice the word portion again, of a trust in respect of which so these are powers normally held by a trustee, which can result in grantor trust status, administrative powers. And the focal point of the Benson case is code section 675.2 and code section 675.3, okay? 675.2 says the power exercisable by the grantor or a non-adverse party or both enables the grantor to borrow money, corpus or income, directly or indirectly, without adequate consideration, without security. Let's stop there. Okay? So if the trust could lend money to the grantor, directly or indirectly, and to say, let's suppose the trust has $1 million. Oh, you want to borrow $100,000? Here, borrow it. Don't worry, you don't have to pay us interest. Don't worry, we don't need to secure it with your home, right? If that's permitted, right? Do normal trusts permit that, guys? No. I mean, usually most trusts have pretty regimen that you have to, as a fiduciary, you have to command adequate interest and security, right? Or else your neck's on the line. So if a trust has that, that's problematic. It can make it into a grantor trust, except where a trustee is authorized under general lending power to make a loan to any person without regard to interest or security. So there's a pretty big, how do we say, safety net there. Because you, meaning each of you, could set up a trust and put in that power and permit your friendly trustee. You're not going to choose someone who you don't get along with, right? You're going to choose someone who you like, and they might turn around, you put in $1 million, they might lend you back $100,000, right? And in yesteryear, the idea, remember, was to avoid grantor trust status, right? Everybody agree? To avoid grantor trust status. So this seems pretty much like your piggy bank, right? Where you can put money in, and it could come right back out to you, and meanwhile you can command the lower tax brackets. By the way, let me make an observation final observation about code section 674, beneficial power of enjoyment. Again, in the year 2016 and going forward, are you going to have set up trust in which you're going to allow the grantor to retain indicia of beneficial ownership, guys? Are you going to purposely set up that kind of trust? And think to yourself, why do you set up trust these days? In the year, you set it up, say, if your surviving spouse or your spouse during life, because it's a second marriage, or you're fearful your spouse is losing his or her mental facilities, or your spouse is Arnold Schwarzenegger and you think he might run off with someone, so you don't want to give him full control of the money. Or it's, what's the golfer? Tiger Woods. The list goes on, right, guys? Unless I'm mistaken, the list is a lot longer for men than women, right? Having said that, my point is, there's lots of reasons to set up trust. Agreed? Protect your, if it's a second marriage or first marriage, or regarding your spouse, your children, might be spending money wildly. You might want to save estate tax, but is there a good reason to set up a trust in the year 2016 in which you retain some beneficial enjoyment where you can still control things behind the scenes? And the answer is probably not, right? Everyone agree? Probably not. So are we going to run in afoul of Code Section 674 too often?
Probably not.
Probably not. That's reality. Just like Code Section 673, probably not. 674, probably not. But I want you to be aware of these code sections because they can come up in this day and age because people do, I told you, wacky things on the internet. And they think, gee, I can just get this template and create a trust, and who needs to spend $2,500 on an attorney, right? So I'm just telling you, it's not like, well, this is wasted time, you'll never see this, but I do want to point out these don't come up with regularity, albeit, I'm going to explain in a moment why 675 does come up more often than you might think. So, 675(2), a power to borrow without adequate interest or security. That can be, 675(2) can be worked around, as I just described. It has this gaping exception. Because you can install a friend, and that friend, so you can have that provision and say, oh, anyone can be lent money without interest and security, and you're not going to run afoul of 675(2). However, if you borrow the money, if you actually borrow the money, look at 675(3). The grantor has directly or indirectly borrowed corpus and income and has not completely repaid the loan, including interest before the beginning of the taxable year. The preceding sentence shall not apply to the loan which provides for adequate interest and adequate security. Okay, so there is a period there, so let me stop reading. In other words, if there is a loan outstanding, it is going to be considered a grantor trust, okay? And it says the preceding sentence shall not apply to a loan which provides for adequate interest and security if such loan is made by the trustee other than the grantor and other than a relator, subordinate, or subservient to the grantor. Okay. So let's just, if a loan is actually made, it's going to be considered a grantor trust unless it's made by an independent, essentially by an independent trustee, and there's adequate interest and adequate security, meaning it's truly a bona fide loan. If it's a truly bona fide loan, then the grantor trust rules do not apply. All right, bearing that in mind, guys, let's look at the Benson case. We have a taxpayer. In 1968 through 69, in 2 different years, bought real estate for an appliance center in his individual name. In 1970, he moved the appliance business to the property and enters into a lease. So he has his enterprise lease the property. And then he took this property and put it into the Benson short-term irrevocable trust. And at the time he contributed the property, it was subject to a mortgage. That's critical. At the time he contributed the property, it was subject to a mortgage. So he contributes the property to the trust, and it's subject to a mortgage. and it's a 10-year, 10-day kind of trust. So it's a typical so-called Clifford trust. The trustee made several loans to the grantor. The loans were unsecured. No interest was paid. And the question is this a grantor trust? And if so, what does it mean when it says a portion? Okay, so everyone have that? That the trust is 10 years, 10 days. Income is supposed to be paid annually to the 4 minor children. The wife is the trustee. The trust does provide that you can lend to any person for reasonable interest and security. So the terms of 675-2 are not violated. I'll repeat. The terms of Code Section 675-2 are not violated. Why? There's no power to permit the grantor to borrow without adequate interest or security. If 675-2 were violated, we would never get to 675-3. But 675-2 was not violated. Now, she was supposed to only lend for adequate interest and security. She violated the terms of the trust, okay? Let's face it. The terms didn't permit it, but at least on the face of it, the trust instrument itself did not violate Code Section 675-2. Does that throw us in the mud with respect to Code Section 675-3? And it says 675-3 provides a portion of the trust will be treated as a grantor trust if the grantor has borrowed money and is not repaid it by the end of the year. So if you stop reading there, is it a grantor trust? Yes, right? Because these loans have been made. Does the exception apply? No, the exception doesn't apply because there's no adequate interest or security, right? Everyone get that? The loan was outstanding at the end of the year. The exception did not apply. So we're in the mud with Code Section 673. What is the taxpayer's argument? How much income would the taxpayer like to include? Let's just suppose there was $1 million of income, $1 million trust earning a 5% return of $50,000. Okay? The taxpayer would like to take the trust income times the loan outstanding over what's the denominator? Value of the corpus. So the taxpayer would like to take the argument, look, let's face it, guys. The loans outstanding were not big numbers. Agreed?
Right.
The value of the corpus was pretty high. So the trust income that would be considered a grantor trust would be relatively small. Agreed?
Yep.
The IRS, instead, would like to take the trust income times the loan outstanding LO, loan outstanding, and the denominator would be the trust income. Without any distribution deduction. And the loan outstanding is going to be a pretty large number relative to the trust income, right? The denominator here is much, much smaller, agreed?
Yep.
And to the extent, again, keep in mind the psychology. To the extent it's a grantor trust income, it's going to be subject to higher tax rates than what were the then low tax rates of trust and estates. What happens here? What does the court rule here? What would you rule here? The court ruled here that the taxpayer was off. Okay? That the taxpayer position was off. And essentially the court wasn't clear if it's ambiguous whether or not the court accepted the government's argument. It just simply said, look, whatever income was earned here, essentially all of it was lent out to the taxpayer. I'll repeat. Whatever income was earned here, these dollar figures here, if you see on page 276, the dollar figures, what was lent, that constituted the mainstay of all the income that was earned. If you look at the income that was earned for 1973, 74, and 75, the amount of the outstanding loans, because remember the loans were not payable, were not paid until 1976, and if you tally the amount of the loans, they exceed the amount of the trust income for each year that the loans were outstanding. So the court essentially said, well, we're just going to treat that as if all the income was then taxable to the grantor. All right, so what's my takeaway here? Because I know what you're going to ask. And let me just point out what I have in my notes in the textbook. If you look at page 280, in the material that follows, here's my observation. If you read this, and I hope you do if you haven't already, I put down confusion ratings, okay? And when you look at the various court cases in the IRS position, that generally, look, I think everyone here, I hope everyone can identify if the grantor trust rules apply, meaning if this is going to be considered a grantor trust. That's 80% of the battle. The remaining 20% of the battle is to decide what portion of the trust is going to be considered as a grantor trust. You know, what portion of the trust, and namely, should one of these formulas apply, which one, and it's not, if you read the material that follows, it is not clear. So generally, whether I'm right or wrong, call me a simpleton, but in my mind, to the extent money is lent out, whatever money is lent, that money would be income, in my opinion, that should be, that to me represents the portion taxable to the grantor. So if the trust earns $100,000 and it lends out $20,000, okay, the grantor should be taxed on 1/5 of the income, $20,000, okay? Conversely, if the trust lends out $170,000 and the trust had earned $100,000, well, we'll cap the income taxable to the grantor at $100,000. Now, am I sure that's the right answer? I'm not sure, but you know, as a professor, I could probably spend a half an hour or more, 45 minutes, talking about all the different ways courts have come up with derivations of the word portion. And I will say a few things. I don't know which one is right with a capital R. 2, does this come up much in practice? Do many trusts that I've dealt with permit taxpayers to borrow money from a trust? And generally, for estate tax purposes, no one borrows money from a trust. No one does. Okay, for fear of estate tax inclusion. However, so you might say 675 doesn't come up much, but you'd be wrong. And why would you be wrong? Look at code section 675 4C. Let's look at 675 4. It's entitled General Powers of Administration. A power of administration is exercisable in a non-fiduciary capacity by any person without the approval or consent of any person in a fiduciary capacity. But for purpose of this paragraph, the term power of administration means one or more of the following powers. So let's put it this way. If you have one of the powers that are about to be enumerated, it will be treated as a grantor trust, okay? Everyone hear me? That if you have one of the powers that are about to be enumerated in 675-4, grantor trust. So look at paragraph C, the last provision. A power to reacquire the trust corpus by substituting other property of equivalent value. Okay? This is considered a power of substitution. Suppose each of you set up $1 million trust for your children, and you retain no additional control, right? You want to keep that $1 million outside your estate. Everybody agree? And this is intervals during your lifetime. So these are, you're going to set it up for your children. It's going to be for, you know, let's suppose each one of you, just to make it simple, you're 25 years old and you each have a 1-year-old baby. Okay, get the visual? And you're going to keep it in trust until your child reaches age 40. Okay? And for the next 39 years, you set up again, you put in this $1 million, and the expectation is that you want this $1 million to grow over the next 39 years, so at age 40, this money will vest with your child. If the trust has to pay income tax, and that $1 million, let's say the trustee, I'm the trustee, just make it simple. Good news for your team is somehow, some way, I miraculously get a 10% return. And it's income, okay? It's not capital gains. And so every year, there's $1 million that generates $100,000. And if the trust has to pay tax, how much tax is going to be paid each year? Let's just keep it simple, 40%. So each year, even though the trust gets $100,000 in cash, it's going to be out $40,000. Agreed? So every year, not bad. The trust goes up from $1 million to $1,060,000, right? Everyone got it? And I can't do it because you guys can do it yourself. What's 10% of $1,060,000 is, you know, each year it's gonna, and then you gotta reduce it by 40%. Okay, it's growing and it's a nice growth. And you'll see in practitioner journals, what do taxpayers and tax planners do now? And I hope, did most of you get my grantor trust piece? Yes, no, I sent it this morning. Okay, you should. Okay, so if you're having trouble sleeping at night, go read it. No trouble putting it to bed. But, all right, let's picture, if you will, you set up this trust for your child and you're fairly wealthy, right? Why not make it into a grantor trust? Okay, picture, if you will, now. You will purposely put in a power of substitution under 675 4C. Power of substitution. Why? Because you can, as long as you have this power, even if you don't substitute, the power simply says you have the right. Suppose it's $1 million building that's giving you that great 10% return rental income. You have the right to take that and switch that building and put in a building of equivalent value. That's all it is. A power of substitution. That makes it into a grantor trust. And what that means is over the next 39 years, you have to pay the income tax on that. Okay, so what does that mean? Every year you've got to shell out $40,000. Having said that, how is the trust going to grow now? Instead of growing each year by $60,000 a year approximately, it's going to grow by $100,000 a year, right?
Yep.
At the end of 39 years, is that going to create a monumental difference? Absolutely. You're going to, what practitioners call supercharge that trust, right? And here's the critical point. By you retaining a power of substitution, there is no equivalent power under Chapter 11, 12, and 13 of the Code, which deals with transfer taxes, meaning if you die during the next 39 years, that trust does not come back into your estate. In other words, the estate and gift tax laws and the income tax laws are not written in a way that they dovetail with each other. So in this particular instance, I told you about the reversionary interest, that no practitioner sticks in a reversionary clause, because if you do, you shoot yourself in the face, because even if you give yourself a 2% reversionary interest, it comes back for estate tax purposes. And people say, why did we do? We did this specifically to get the asset outside of my estate. And also I told you with respect to beneficial enjoyment provisions, no good, because it thwarts your ability to keep it outside your estate. But with Code Section 675 4C, that's one of the few provisions that you can play this game, toggle, and get the best of both worlds, where you get grantor trust status, and you can supercharge that trust so it grows remarkably fast and quickly and high, but simultaneously you have no estate tax issues. So now you can see why, in my humble opinion, among other reasons, why the grantor trust rules, largely, they had their purpose prior to 1986 when tax rates were really low, right? The IRS had to fight against people having indicia of control. In my opinion now, if you call something a trust, you got to live with it, and it should be subject to any income or forget it. Let's suppose now we didn't have the grantor trust rules. We just repealed them wholesale. Guess what? Would taxpayers want to keep income in the trust? No. Right? Everybody agree? But now people want to use grantor trust status because it can mitigate the overall income tax burden, right? Because individuals are typically taxed at a lower rate than the trust itself. So just as we're going through this, now, notwithstanding it's Wednesday night, you might say, gee, Solid's saying the grantor trust rules have seen their better day. That may be true, but this is, 30 years later, Congress could have repealed the grantor trust rules, and they don't seem to be going anywhere too quickly. Anyone, disagree with that? But my point is, do they come up? There's some other cases, but many people use this power under Code Section 675 4C. If you don't have your computer open, Anthony, but if you were to Google it, and you were to put in, Adrian, if you were to Google it in your computer, you would see supercharged trust, power of reacquisition, that would come up, a lot of hits in Google, a lot of hits in Google. All right. Now, there is this Rothstein case, okay? Not the easiest case to read. We have a taxpayer in 1951. They form a corporation. The taxpayer paid $30,000 for real estate transferred to the corporation. Some of you may recall. You form a corporation at the 351 transaction, right? Generally tax-free, it's only if you meet the control test under 368C. Okay? So they form the corporate entity, and the corporation takes over the basis of the shareholder, Code Section 358. In 1957, the taxpayer takes the stock of the corporation and transfers it to a trust in which his wife is the trustee. Okay? Then the taxpayer decides, you know what? I want to buy the stock from my partner, and it's going to pay $500,000. Remember, two people, the taxpayer and this guy, Sabin, however you pronounce it, S-A-B-I-N. The taxpayer buys his partner's interest for $500,000, and he buys the next month in 1964, he buys the stock from the trust. So he makes two acquisitions, the taxpayer. Picture, if you will, he buys again 100% of the stock overall, half from his partner, the other half from the trust. How does he pay the trust? He pays using an unsecured promissory note. The next year, he dissolves the corporation, corporate liquidation. And he pays off his partner, but he doesn't pay off the trust. So picture, if you will, again, for our purposes, we have a taxpayer buying stock from a trust that he formed. He was the grantor and his wife is the trustee, in which he pays using a promissory note. Okay, everyone get the visual? So put yourself, role play, you set up a trust, it owns stock, and you buy that stock using a promissory note. Is that a grantor trust? And this turns on the application of Code Section 675(3). This turns on the application of Code Section 675(3). Taxpayer says 675(3) is non-applicable. Why? Taxpayer says, look, a loan is a loan is a loan, meaning you can only call a loan if the trust lent money to the taxpayer. There is no money being lent to the taxpayer, right? Here, it was merely a sale. Remember, you bought stock, right? There was no lending, albeit you used a promissory note. And what does a promissory note connote? right? Isn't it the same thing as if, in this case, suppose the stock was bought for $320,000? Isn't it the same as if the trust lent the taxpayer $320,000 in the form of a loan and he bought using that $320,000? In other words, the fact he issued a promissory note, isn't it tantamount as if the trust had lent him money? And that's how the court sees it, through its perspective. That even though this is not a loan in the traditional sense, the fact that the taxpayer purchased these shares vis-a-vis a promissory note was the equivalent of a loan. Okay, so does everyone understand that's a key to grasping the Rothstein case, is that there was an actual, or I should frame it differently, there was a de facto loan to the taxpayer. Why? Because of the utilization of this promissory note. And as such, and since the promissory note was unsecured, hint, hint, this code section 675.3 apply absolutely, okay? So now that we agree it's grantor trust, what are the implications? What are the implications? Now, under the Rothstein case, the majority holding says treated the trust. Remember, it's a grantor trust, but the majority says treated as a separate legal entity. I repeat, the majority says treated as a separate legal entity. Why is this important? Because if it's treated as a non-entity, can you have a transaction with yourself under the code? No, right? Everyone agree? If it's not treated as a separate legal entity, you cannot have a transaction. If in the majority opinion, it's treated as a separate legal entity, which it is here, treated as a separate legal entity, what does that mean? It means you can engage in a transaction with that entity, right? And the court says, so when the taxpayer purchases the shares, if it's treated as a separate legal entity, what is the taxpayer's basis in those shares? Costs, right? Code section 1012, whatever they purchased it for. In contrast, if it's not treated as a separate legal entity, right? Can you buy shares from yourself? No. So the transaction would be ignored, and you would have the basis of the trust because you're treated as one. But that's not what Rothstein said. Rothstein says treat it as a separate legal entity, and in the opinion of this court, that just means under Code Section 671, whatever income or losses occur in the trust separately end up on the taxpayer's return. To the extent it's a grantor trust, treat it as a separate legal entity, but whatever income or losses or credits, whatever all those may be, they end up on the taxpayer's Form 1040. Right? So the Rothstein court says you can have bona fide transactions with your grantor trust. And I point out on page 286, right after the indented language, it says, Section 671 makes it plain that it was not Congress's intention that the taxation of grantor owners be governed by what otherwise may seem like a sensible general principle that the taxpayer may not have meaningful dealings with himself. Rather, the statute envisions, so this court is saying that it is treated as a separate entity. It's not to be ignored. The statute envisions that income and deductions of the grantor and the trust be computed in the normal fashion, the trust being treated as a fully independent tax-paying entity. And two, that the relevant items of income, deductions, and credits against tax that would ordinarily appear on the trust return be included in the taxpayer's return. So, that being the case, under the holding of this court, the taxpayer's purchase of the shares would be respected. He would get the higher tax basis. And what that means is his computation on page 282. You see page 282? He says cost of stock acquired from the trust, $320. That is what he paid. Now, the IRS would say, no, and it resulted in a loss, right? Everyone agree? And to him personally, the IRS position is, no. He couldn't have had a transaction with himself. That his basis in those shares should have been $30,000, and therefore, when the company was liquidated, he would have had the numbers would have changed by $290,000, right? Because instead of having an additional basis of $320, it would have only gone up by $30. So where did I get $290 from? $320 minus $30. So there would have been a difference of $290,000, resulting in a gain.
It didn't bother anybody that he paid $500,000 for 300 shares at one point?
I understand. He paid 500,000 shares from one person and 320 from the shares from the trust. That doesn't seem to be an issue that they addressed. Okay. Now, you might say, what is the relevance of this case today? Fair question on your part. What's critical, in my opinion, remember, a court says one thing, but the IRS is an administrative agency that has to decide how it's going to respond. Look on page 291. This revenue ruling is key, so just bear it in mind. This revenue ruling is key. 85-13. It says, it will not follow. The IRS is not going to follow this decision. Insofar as it holds a trust owned by a grantor must be regarded as a separate taxpayer capable of engaging in sales transactions with the grantor. So it says it's going to ignore this decision. And it's ignored it now through the arithmetic for over 30 years. The IRS justified its position as follows. It's anomalous to suggest that Congress, in enacting the grantor trust provisions of the code, intended that the existence of a trust would be ignored for purposes of attribution of income, deduction, and credit, and yet retain its vitality as a separate entity capable of entering into sales transactions with the grantor. So, what the IRS position is, in Rothstein, essentially, taxpayers who engage in transactions with grantor trust have to recognize gain and losses. Agreed? But the IRS has taken a position which now taxpayers have used against the IRS, saying, no. Those will be ignored. And what happens under Revenue Ruling 85-13, hear me on this, and again, if Adrian were to Google this, there's a lot of, and you might, for fun, use the word fun loosely. If you were to Google sales to defective grantor trust, I'll repeat, sales to defective grantor trust, where taxpayers now will purposefully engage in selling appreciated assets to, and it's called defective grantor trust because essentially it's a grantor trust, okay? So the tax planner purposely puts in a provision like you just saw under section 475 4C, which makes it into a grantor trust. So it's intentionally a grantor trust. And let's suppose you have 2 children, each one of you in this room, and you have an appreciated asset that you bought for $100,000 that's worth $1 million, and you sell it to your trust, right, for $1 million. Okay, everyone get the visual? You sell it for $1 million. It's a grantor trust under Revenue Ruling 85-13. Is that going to be considered as a taxable transaction when the grantor trust issues a promissory note? Is that going to be considered a taxable event? And the answer is no, because the IRS has ruled, notwithstanding Rothstein, that it's going to ignore Rothstein. So the trust is able to buy this appreciated asset. It will take over a basis of $100,000, right? Because if there's no gain recognition, even the IRS isn't going to allow you, the trust now, to have $1 million tax basis in that asset. And what will end up happening is that if there's an independent trustee and there's adequate interest and security, it's a grantor trust under section 675 4C. For estate tax inclusion purposes, there won't be any estate tax inclusion, and you can get this highly appreciated asset out of your estate that has a fair market value of $1 million. You can keep it outside your estate. What's the takeaway here? The takeaway here, guys, is there is the Rothstein decision that says treat it as a separate legal entity. But I'm just telling you, for the last 30 years, the position of the IRS is to ignore Rothstein and say it is not, you cannot engage in transactions with your grantor trust. You got me? Yeah.
In your example, what basis do the kids get?
They get the original 100,000. 100,000. Because it's ignored.
Yeah.
Right. Let's do problem 4-12. Where does 12? Grantor creates an inter-virus trust. All the income is to be paid to child, G's child, for C's life. Upon C's death, the trust is to terminate, and the principal is to be paid to C's then living issue per service, right? It's a generation skipping trust, right? First National Bank is trustee. The 675 treat G, the 675, excuse me, treat G as any portion of owner of any portion of the trust. Let's repeat that. Each one of you set up a trust. All the income is to be paid to your children or child. You each have a daughter. It's going to be paid to your daughter. You're going to put in $1 million for her lifetime, and upon her demise, it goes to your grandchildren of your daughter, right? And we're going to have the terms of the trust, and you're going to name First National Bank as trustee. Patrick, is that a grantor trust or not?
674C.
74C?
First National is...
I agree with you. It's not a grantor trust under 674C. Is it a grantor trust under 675?
The 675.
Yes, no, maybe? 675? No. Don't look to, look, each one of you set up this trust for your daughter. Do you feel like you have much control over its administration, guys? I mean, when you're doing these problems, whether for examiner or client, you're allowed to do a little bit of a smell test. Obviously, that doesn't go far enough, but at least have an initial reaction, right? So it is not a grantor trust. 4-13, assume the same facts as 4-12, except that you retain the right to reacquire the property from the lender upon tendering to the trustee property of equal value. Grantor trust?
Yes.
Yes, right? This is the quintessential. Section 475, 4C, right? But section 475, 4C. (4-14). Assume the same facts as in problem 4-12, except the trustee is authorized to make loans to the grantor without adequate interest or without adequate security. What if the trustee were authorized to make loans like that to everyone? So suppose the trustee is authorized to make loans to the grantor without adequate interest or without adequate security. Is it a grantor trust in that case?
Yes.
I'm sorry, Anthony?
Yes.
Yes. Under 475-2. What if the trustee were authorized to make loans like that to everyone?
Only if it was repaid within a year.
Then it's, no. If there's no loans outstanding, look,
Okay.
if it's authorized, it's problematic in 475-2 if it's only authorized to give it to you.
Right.
Okay? But if it's under 475-2, you cleanse it by making loans, authorize it to make it to everyone. Okay? So in the second one, it would not be grantor trust in the second part of the problem.
675.
So the second part of the problem would not be a problem. If I'll call it derelict loans could be made to everyone. 4-15, same facts in 4-12, no language in the trust agreement authorizes the trustee to make loans without adequate interest or without security. And G obtains a loan, a no interest loan, but she gives no security. G has not repaid the loan. Is that problematic?
Yes.
Everyone agree? What's your authority for making a grantor trust?
675. 3.
3, right? 675-3.
They violated the trust agreement?
I'm sorry again?
They violated the trust agreement?
It doesn't matter if he violated it. If he did, it doesn't matter. Meaning, even if it doesn't authorize it and he goes ahead,
Okay.
it's a problem.
Okay.
Even if it's violating the terms. CJ, you look like you have a puzzled look.
You said it's not? grantor trust?
No, I did. I said it's a grantor trust in 4-15A.
You said it is.
It is a grantor trust under the authority of code section 675-3. How about B? While his wife is trustee, G obtains from the trust a market interest rate loan for which he gives full security. Okay? He gives a market rate interest loan for which he gives full security. Is that a problem? Look at the last sentence, code section 675-3. Remember, that exception only applies, right, in the second sentence where it says the preceding sentence shall not apply to a loan which provides for adequate interest and adequate security if such loan is made by a trustee other than the grantor and other than a related or subordinate trustee subservient to the grantor. And then it says for periods during which an individual is the spouse of the grantor, any reference in this paragraph to the grantor shall be treated as including a reference to such individual, which means what? For your notes, that question B,
Grantor trust.
it's grantor trust under 675-3. Let me just make an observation in 14, in problem 4-15, A and B. We, in both, right? CJ, your notes say it's grantor trust in A and B. Agreed? Just to keep things manageable and simple, if we say it's grantor trust under the J. Solid Procrustean approach, if it's a grantor trust, it's going to be whatever is lent up to that amount of income is going to be treated as a grantor trust and taxable. Notwithstanding, different courts have said different things, right? In other words, remember, the verbiage of 675 says a portion of the trust shall be treated as a grantor trust. And when it comes to lending, it's not clear what portion. So just trying to have a simplified rule because there is no right rule with a capital R. There's a whole bunch of different rules, but that's not going to serve us well. So we'll say its income is taxable to the grantor to the extent the money lent is up to the income earned by the trust for that year. And finally, for question C, it says the same facts in problem 4-15, except that G's partner is the trustee when the loan is made. Now, what the question is asking indirectly is your partner a related or subordinate party, right? Is a partner considered a related or subordinate party? Where would you look? 672C2, right? And is a partner considered a related or subordinate party? No, you're not going to see that. That's a glitch, I would say, in the code. It does not include a partner. So this would not be considered a grantor trust. Not considered a grantor trust. So give me a few more minutes, guys, and let's just go through revocable trust and we'll call it a night. So give me a few minutes. And like I said, next week, give me a few minutes to talk about revocable trust, a few more problems. And then let me just talk about next week's, both the reading assignment for next week and the next 2 weeks that follow so that you guys get the landscape, okay? So let me just say this. That powers of revocation are found in Code Section 676, power to revoke. It says the grantor should be treated as the owner of any portion of the trust, whether or not he is treated as such owner under any other provision of this part, where at any time the power to revest in the grantor title of such portion is exercised by the grantor in a non-adverse part of your vote. So let's face reality, guys. Are grantor trusts the norm? You know, we were just talking about grantor trust under where people have 673 doesn't come up much. 674 doesn't come up much. 675 comes up for special kinds of tax planning. 676, does this come up a lot? Yeah, all the time. Because people are typically, as I think I mentioned the last class or two, but now since we're right here, let me mention, irrevocable trusts are extraordinarily common in many states. Why? Because in some states, like California and Florida, revocable trusts avoid probate, which can be time-consuming and expensive. So people set up revocable trusts all the time, and revocable trusts, right, or grantor trusts. Why does it make sense? Why did Congress think? They were the first form of revocable trust. Congress, if you recall the Clifford case, prior to the Clifford case, revocable trusts were already considered grantor trusts. Why? If you could put $1 million into a trust, and any time at your whim and discretion could snap your fingers and get the property back, is that pretty much equivalent to beneficial control and title? Right? And snap of a finger, you get everything back? Absolutely, right? No one's saying you're surprised by that. And again, some people, like Brad Pitt, they want privacy. A will, you probate, someone dies, it's open for the court, it's open to the public to review, and maybe they don't want the public to see their testamentary dispositions. He tries to disinherit Angela, what's her name? Angela? Jolie? Okay, sorry, can't get the name straight. All right, so maybe he doesn't want that public, right? So there's also, another reason, revocable trust. People set up, or used to set up, so-called Totten Trust. This is reflected in Revenue Ruling 62-148. Okay, essentially it's a bank account in which it's payable on debt, right? You put the money into a bank account and you can change it at any point, right? You can change it at any point. And if you do, or you can, it's still going to be taxable to you. Even though it's like a trust, right? It's payable on death, and it's being, upon your demise, you name a specific person as a beneficiary. At any time, you can change your mind, right? So that being the case, it's ignored, and it's treated as a grantor trust. So, again, everyone get the visual. I've set up during my career lots of revocable trusts, not to save income taxes. Do not save a dime of income taxes. Why? It's a grantor trust. It ends up, for tax filing purposes, all in the Form 1040. It's just a device. And I forgot that one other reason set up lots of revocable trusts is to avoid ancillary jurisdiction, right? If you have real estate in multiple states, not only in New Jersey, but you own property in Florida, California, Minnesota, Montana, if you set up a revocable trust, you die, If you don't have a revocable trust, your will has to be probated in each of those states. By having a revocable trust, you don't have to probate your will in any of those states but New Jersey. Tina, you got that? It's too late at night to absorb that. You get this notion that when someone dies in New Jersey, don't sell here, and they have property in Montana, and you want to sell, remember the person's died and you're named as executor of their estate, and you go with a piece of paper to Montana because you want to try to sell the paper. You say, look, the court of New Jersey authorized me to sell this property. And the people in Montana says, well, no. Maybe you just printed this piece of paper off some fancy stationery that you found off the internet. We don't know if you're really authorized to sell that property here in Montana. So what you have to do, Tina, is get an exemplified copy of the will in New Jersey and probate it in Montana. Pain in the neck, it's called ancillary jurisdiction, so that you can get a Montana court to issue you letters testamentary, so now you can sell that property in Montana and someone says, oh, you're authorized, you're legit. If you have a revocable trust and you're named as trustee, all you have to do is show them the copy of the trust and say, look, I'm trustee, I'm authorized to sell the property. You don't have to go through the court system. For income tax purposes, that trust is entirely ignored. The good news for your team, the problems are pretty easy here. Look at problem 4-16, okay? Nothing tricky here, nothing. If you see the word revocable, guys, you're getting to the promised land, okay? It's easy. Assume the same problem in 4-12, except the trust is revocable. Let's just keep our fingers in 4-12, right? Where we named First National Bank as trustee. If it's a revocable trust, even if First National Bank is named as trustee, is it a grantor trust, guys?
Yes.
Yep.
Absolutely, grantor trust. Now, if you have a trust, which is ultimately going to pass to your child, okay, right? Everyone got that? We have a trust we set up, it's revocable. We die, it goes to our child, and it says, the trust is revocable by each one of you, the trust that you set up, but you need your daughter's consent. Now, she consents. She risks losing that $1 million because you just found a new boyfriend or girlfriend and you decided you're not going to leave that money possibly in trust. You're going to leave it to the new boyfriend or girlfriend, right? Is your daughter adverse to you?
Yes.
Absolutely. Is it a revocable trust? It's revocable, but since it can only be revoked with the consent of an adverse party, it would not constitute a revocable trust, okay? This is under Regulation 676A-1. I'll repeat, 676A-1. Final question. Assume the same facts in 4-12. The trust is revocable by G, but only with the trustee's consent. Now you need First National Bank.
First National Bank is a non-adverse party.
First National Bank is a non-adverse party. So does that
Therefore, 676
These are
applies.
676 would apply? It would be considered a revocable trust, right?
Yep.
The trustee is not an adverse party under 672. So give me 5 more minutes to talk and give you the lay of the land, what I'd like to cover for next class. So hear me on this. we have two more code sections to look at. 677, okay? Code section 677, which talks about income for the benefit of the grantor. Obviously, if income can be expended for the benefit of the grantor, guys, it has the aroma of control, right? And as such, we saw an example of 677A2, right, with respect to capital gains. Agreed? The reversionary interest, 677A2. And now we're going to go further, and we're going to look at retained, the income interest. We'll go through that, and where it can be used to discharge legal obligations, and we'll see some cases there, kind of interesting in my opinion. Now, beginning on page 317, you will see the so-called Mellencroft case. Mellencroft. Okay? You want to have a good time at a cocktail party? You can name drop the Mellencroft case. Okay? That will make I am sure, the hit of every party. Mellencroft case is the predecessor to Code Section 678. Okay? For the first time, you know how we talked about the grantor being in the owner of the trust, right? Under the rules, the grantor trust rules, the grantor. Well, under Code Section 678, I'm glad everyone is sitting down. You might otherwise trip up here. Is that 678 says the beneficiary is going to be considered the owner, okay? Not the grantor. But suppose I set up a trust with $10 million, and I name each one of you as a beneficiary. Okay, get the visual. I set up trust for $10 million, I named each of you as a beneficiary, and I gave you certain rights that were so powerful, the rights, that it gave you close to indicia of control over the trust as beneficiary. In that instance, income earned by that trust, even though it's earned by the trust, but because you have, and some of you may remember from your income tax course, a doctrine called claim of right, and you may remember a case called North American Oil that said essentially that if you have the right to control income, that's tantamount to ownership. Again, very similar to the assignment of income cases, and therefore you should be taxed on it, all right? So you're not going to be surprised if you as beneficiary and command control over that, who should be taxed? You should. What's my authority? Code Section 678. All right, so we're going to go through Code Section 678, and then we're going to get to page 322, talks about the actual code and its application. Then on page 329, we're going to talk about the actual consequences. The first part of this chapter, or the large part of this chapter, deals with simply identification. What is a grantor trust, right? Everyone agree? What is a grantor trust? We haven't really spelled out the consequences. Indirectly, I've spoken up here about what are the consequences. Beginning on page 329, we'll actually look at some actual consequences and go through some problems where we'll see it applied. Okay, so that's the good news. On page 334, the authors walk us through some problems and see how it actually applies. Good news for your team is on page 335, there's a discussion called distribution deduction. I don't think you need to read this. This is not going to come up in your practice, and there's one long case there, and I don't think for our purposes it's going to be highly relevant. Now, in terms of things that I distributed, let me just call attention. So, next class, guys, remember, we're going to go from 6 o'clock to 8 o'clock because and we won't take a break, okay? So, just plan to go 2 straight hours, all right? But let me just talk for 2 minutes about what I distributed and what my game plan is here. All right, notice, if you will, that this is double-sided, okay? And what we're going to do here is we are going to talk about charitable remainder trust and charitable lead trust. And if I can, just so so you know, Rutgers, and you may have found this out too, Rutgers is going through where they're upgrading their email system. So it's not, right now, it's impossible to get a scanned version. I would have scanned this and asked you to print it out. The good news for your team is I couldn't do that, so that's why I'm distributing this in hard copy. I will see by next week if everything's going correctly with the Rutgers update, if I can send you some prototypes of some charitable remainder trusts, because the IRS has published prototypes of these trusts, and we can talk about, our objective is the second to last class, we'll talk about charitable trusts, and then we will talk about the very last class, this much longer piece dealing with IRD, income with respect to decedent, through section 691. We will go through and look at how these are taxed. So that gives you a lay of the land. We have 3 more classes right before the exam. Next class, we'll finish reading this chapter, our textbook. I will have a short discussion of whatever time remaining, talking about charitable trust, so that 2 classes from now, we will master, I hope, charitable trust, and then our last class, we will delve into IRD. Any questions? Okay? You guys are good? So what? Listen to the game on the radio.